first saw that video, I thought, I'm 100% in Caleb's camp. The math is the math. But then I forgot about one key aspect of the life insurance loan. I thought, I'm going to put the numbers together to prove it. And so I got into doing the spreadsheet, and I surprised myself a little bit because
some people always think that I'm Mr. Crunch the numbers on everything, and I'm actually, if banks are cheaper, then don't gaslight me by saying you're still going to be better off.
this is where you got to put on your other hat that Nelson Nash argues and be your own banker.
Are you ready for me to expose myself? These insurance companies don't want to be a bank. Would you agree with everything I said so far?
Your example there, it did confuse me a little bit.
How do you decide when to use your policies and when not to?
Essentially, the way that I look at everything, it starts with
James Barber from Oregon Cashflow Pro on YouTube. Welcome back to the show.
hey, appreciate it.
We're not going to do an IUL whole life debate, but if that's something that you are interested in, we'll have the video when James came on and debated Chris Kirkpatrick. But today we're going to talk about really two things. I had a conversation with Chris Naugle a couple weeks back, and we were talking about some different loan examples, and that created a lot of attention. I can't tell you how many people actually texted and called me behind the scenes on that. You actually have a YouTube channel that we will also be linking somewhere. We might even be collaborating on this video. And you break down the math, and I want to be able to dive into your thoughts on our conversation and maybe some of the things that I got right or wrong and what Chris got right or wrong. And so we can talk about that. But then I also want to talk about this concept of amortized versus simple versus compound interest, because I actually think that this is something that gets said a lot in the infinite banking community, even in the finance community. There's people that are like, I pay extra towards my mortgage to save on interest, and it's like, I cringe because there's a bunch of half-truths. And I think everything that we're going to be mentioning and talking about, there's a form of a half-truth. The problem is a half-truth is not true because it can be maybe used as a talking point, but in a lot of cases, it's intellectually not accurate. And so when it comes to the whole interest conversation, we'll probably find that these are talking points that many people use to justify maybe certain strategies that aren't actually going to better you. And so with that intro, you watched at least part of my video with Chris Naugle when it comes to what we were talking about interest. Why don't you recap some of the big talking points that you got from just our original video that we had together?
Yeah, so you guys had a discussion, a debate about, is it better to just borrow from the bank or borrow from the insurance company? And obviously interest rates matter to people who really like to optimize and maximize, and that's kind of the space that we live in, I think, is we're trying to optimize and make the best use of the dollars that we have, especially early on when we're in what I call the accumulation phase, which a lot of the people that we interact with, they're in the accumulation phase. So they want to optimize the best use of their dollars now, and that might be saving the most interest, or like you, the stance you like to take, which is don't give up opportunity costs, because there's going to be some opportunities out there that you don't want to miss out on. And the numbers that you guys get into there's definitely an argument for either case. And when I first saw that video, I thought, I'm 100% in Caleb's camp. The math is the math. You pay 4% to a bank or 4% to an insurance company, it shouldn't matter. But then I thought, I'm going to put the numbers together, because you guys didn't do a spreadsheet to prove it. It was just, I guess on your side, it's like, it's just logic. But, and in my mind, that was the case as well. And so I got into doing the spreadsheet, and I surprised myself a little bit because I forgot about one key aspect of the life insurance loan. And that's when you make your payments, you're knocking out principal. That life insurance company is going to bill you for the interest once a year. And if you don't pay the interest, then it gets added to your loan. Whereas the bank, every month you have to make a payment, and the interest portion of it goes to the bank. It disappears. Whereas on the life insurance side, that interest portion is part of your overall principal payment. And I'll show you how this looks in the spreadsheet that I did.
Yeah.
But it ends up saving you money because you're going to knock that principal down quicker.
And we're going to get into the numbers. I think there's two things that I just want to clarify before we jump into the numbers. Number one is, and we're especially talking whole life. I know you do whole life and IUL. Where in whole life insurance companies, when you take a loan, I think some people don't actually know this, that when you're taking a loan against your life insurance and when you pay interest, the interest doesn't go back to you. It goes to the insurance company. Are we so far so good? Like that's something that I think some people, whether they read a certain book or they maybe have been taught some way, they may actually think that they are recapturing interest by, the interest that they're paying on the loan is actually going to them, and it's not. Are we on the same page there?
Correct.
Okay. The next thing that I'll say, and I'll just use round numbers, if we're going to take a $10,000 loan, and I'm going to take a $10,000 loan from a bank or a $10,000 loan from an insurance company, if I'm taking it from the insurance company, are they actually tacking on the interest up front? And so I'm actually taking a $10,500 balance. That's my understanding of how it works. If it's a 5% loan, it would be, $700 tacked on up front. So because when we get into the numbers, we can get really, really technical, but you could make the argument that life insurance front loads the interest versus when you go to a bank or something, you're taking out an actual $10,000 loan, and then it all evens itself out at the end of the year one, if apples to apples. But how they give you the money is different. Is that how it works, or am I misunderstanding like how loans work?
That is a great question, and it's part of one of the things we brought up in the debate I had with Chris Kirkpatrick on your channel. Was some insurance companies will charge you the interest up front and some of them don't. And a lot of people seem to think that there's an advantage to having it charged in arrears. Well, a lot of those companies that charge it up front will charge you a lower rate because by the end of the year it ends up equaling what that actual rate would have been. So like Guardian says they have a 5% loan rate, but their actual loan rate is like 4.66%, and they charge it to you up front. So they're not charging you $10,500 up front, and then that $10,500 is sitting in the account charging interest on the $10,500. So there's not really a difference here. You're not, just because they're withholding it up front, they're only sending you the bill for it at the end of the year, assuming you're going to hold it for the whole year.
I see.
So if they charge you up front and then suddenly you have a $10,500 balance that's also being charged daily interest, that would be totally different. But that's not.
I think another way to say this is, if it's truly if we're truly looking at a 4% versus a 4% or a 5% versus 5%, it's a total wash. But where we need to push back on is it's one of these scenarios is not true 5% because of how it's actually working. Is that a way to almost summarize this?
Yeah, basically, we can simplify it when we think about when does the interest due? When does it come due? When does it disappear from your balance sheet to their balance sheet? And for a bank, they're always charging you interest monthly. They don't want to wait longer than monthly to get their interest. And when we collateralize our policies outside with another bank, they may not make us pay that monthly interest, but they're going to tack it on and compound it monthly if you don't pay it. Whereas on the insurance company, they're just sending you that bill once a year. And only if you don't pay that will it then compound.
Yeah, I see that. And so really in banking, they are required to have some type of like APY kind of deal, where it's like truly disclosed annual percentage, of your and with life insurance, I don't necessarily think they are required to do that. And so and in some cases they should, because it actually makes their situation more attractive. But is that really the difference? It's like if you're working between a commercial bank versus a commercial bank, this is less of an issue because it's way easier for it to be the rate to be disclosed. But insurance companies don't actually maybe have that annual percentage disclosure. Is that am I on the right track?
I think the annual percentage disclosure is helpful for a consumer.
Cool.
Yeah, when you're comparing commercial bank to commercial bank, the difference is if they're both offering 4%, the differences are going to be what are the fees that they're charging, origination fees, other fees that they might charge, and then when do they compound?
Yes.
Is your line of credit compounding daily, continuously, monthly, yearly? Like that's the differences in the weeds.
Yeah, James, I'm going to get myself in trouble with the team, but if there's enough people that comment that they're interested, it would be really interesting to take the top insurance companies, both on the whole life and IUL side, take their interest rate and actually do like what's the actual interest rate based on how they do things. I think that would be really interesting. I don't think it would be that difficult once it's front loaded with the work. And so if that's something that you're interested in, maybe we'll create a free calculator tool that you can like plug in different company. And obviously it might change between what type of loan, but I'm just now curious myself to be like, okay, all the companies that we represent, I know in the grand scheme of things, if you care about like the exact point, it matters and it doesn't. Like if it matters because truth is truth, and it's like if you're trying to decide whether you take a loan based on like $1 or $2, probably the answer is no. Probably don't do it. That's my non-financial advice to you. But why don't we jump into the spreadsheet? Why don't you break down, knowing that context? I think that's going to be helpful. And let's break down. I think we had a few examples. We had the apples to apples comparison, which is not apples to apples. But we're saying like a 4% loan over here versus a 4% loan over here. We'll cover that. And then we talk about, well, what if it was a 6% loan, but that your insurance company would give you, and then a 4% loan that you could get from a commercial bank, and you took that additional 2% and paid extra premium. That's where I believe we'll probably agree from a standpoint of the person that takes a commercial bank and pays more to their policy will just by default have more money over time. And then we'll talk about the opposite of, the roles are reversed. Mathematically, you'd be better off taking from your policy, but we can talk about whether you agree or not around keeping liquidity and the value of that. So that's what I think we could do. Before then, we talk about the compound amortized simple interest debate or conversation that really shouldn't be a debate.
Yeah, I think we can find some value in that. I think your team will probably tell you with the suggested video that it'll probably be your lowest performing video of the year. Not a whole lot of people are going to want to dig into those kind of details, I think. But you know what? That's the space we live in.
I think you will be shocked on how many people love to dive in to the details.
Yeah. Well, that's where my channel lives too, is the details. It's kind of like you talk about Dave Ramsey a lot, and his space hits the masses, and we kind of dig into the details and the exceptions. So
that's right.
All right, let me share my screen. Okay, so I put together this spreadsheet, and what we see is we have your traditional bank loan, 4%. This is what the payment would be if you were going to pay it off over the course of 5 years. So if I scroll down, that gets us 5 years.
And interest rate 4%, and you're taking 100,000.
4%.
Okay.
Yeah, and you can even see the calculations I did here. I did this in January, so I went down to the day. So in January you get 31 days of interest, and so I go for each month here. In March in April we get 30 days. January, February, March. Why is that 31? That should. Oh wait, March is 31. It's February that's 28. There we go. All right, so essentially we have every day of interest.
Yes.
This calculates out a little bit differently than when I go in and I do the actual calculators online, because they don't break down each month's actual interest. So they're not quite as accurate as what this would see.
Yep.
But this should be accurate. And what happens is you make your principal payment, and this is what I was talking about, that $339 in interest disappears. It goes away to the bank, and your balance on that whole next month is going to be that much that you're paying interest on. And these are always simple interest, right? It's calculated. Almost every line of credit and mortgage is based on what's your average daily balance.
Yes.
So they're going to calculate what is your balance today, charge it at 4%.
And
year
really,
divided by
and
365.
again, and I mentioned earlier in the video, I said APY, and I meant to say APR, and that's the
Yes.
annual percentage rate, and that's the
Yes,
actual
yield is on the other side.
Yes, and so that is the actual rate, and so what you're even showing in this is the APR is lower than 4% because as every time you make a payment, the rate is lower.
What we see here, and why this APR is lower when you don't normally see a lower number APR than when you're in an actual bank, is because there's no fees added into this scenario.
I see.
So normally when you go and get a loan from a bank, there's going to be some fees that they add into there, and so your APR will start out higher than 4%, right? Mm-hmm. Certainly in the mortgage space, we see much higher APRs. That's because of the fees. So what happens is, what I did for the APR here was I took all the interest we paid over the year in relation to what the balance was at the beginning of the year.
Yes.
And then same thing for the next year. When we get to the next year, we're taking all the interest paid for that year, start with the starting balance that prior year.
Got it.
Okay. So now we know what the numbers are that we're looking at. On the life insurance side, there is interest that gets calculated for that first month, and it's the same interest because it's 4%. But then we send money into the life insurance as a payment. And that money knocks out all the principal on that whole loan, the line of credit. Now, this is where you could come in and say, well, maybe it should have been the interest added at the beginning for the companies that charge it up front, right? And so I didn't factor that into here. But you could make that argument that in some cases you will need to do that, in other cases you wouldn't. And in that case, that loan rate may change. Like I said, Guardian says 5%, but they don't actually charge 5% up front. Okay?
Right.
But essentially, you're knocking out the principal. So the principal balance, the average daily balance starting for the next month, is about $300 lower.
And another way of saying it is, instead of the $339.73 going to the interest, it's actually paying down the principal.
It is.
Okay.
Yeah, because the interest is just kind of growing off to the side. It's a side account that says you borrowed the money for this long, and we're going to send you this bill at the end of the year.
Got it. And do all companies work that way? Because
the ones that I'm aware of, yeah. I mean,
okay.
I own a bunch of different policies, and I only get billed once a year for that interest.
Got it. And so you're saying that if just to be extreme, if you had a $100,000 loan and you paid it off after day one, the interest that you would at 4%, you would do 4%. You would 4%. What's one day of 4%, and that would be the interest that you technically would owe for that
Correct.
1 day loan. Okay.
Yep, exactly.
So the big difference here is you're actually getting the benefit of this interest as you're paying back. Instead of it going towards interest, it's paying down the principal, and by default, you're going to be paying less interest over time.
Yeah, and you can see that with the APR being just a little bit lower each year in relation. And this was Naugle's argument. I haven't seen his calculators, but I imagine his calculators are showing the same thing, where the reason he advocates for this is because you do end up saving money.
Right. At this now, can I have a?
Let's look at the actual. Oh yeah, go ahead if you got something else.
So you're yes. So I think in the when I make oversimple, because it's like when I say 4%, no commercial bank right now out there is giving car loans at 4%. Maybe you're ultra wealthy and that's the case, but I don't see a lot of 4% car loans, and I also don't see a lot of 4% insurance loans. And so I think in a way, and this is just a tip maybe for myself from a clarification, I should have been clear and said APR, because my whole goal. And I'll give Chris the benefit of the doubt, but I actually don't know if it'll be interesting to see his software and to see if they actually dive into this stuff. But I'm not sure they get as this technical, and I find that there's a lot of weird math when people say, oh, well, over here, your money is compound. Like they create weird math, not what you're talking about. They almost say like, oh, if you're paying 4%, but you're earning blah, 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 it's actually better. And like, I hate that like debate because it's not true. And so that's when I use the same rate. What I'm trying to establish is there's no magical thing, whether you have an insurance company loan or your commercial bank loan, but I need to get more clear to say APR because actually that would have clarified a lot of issues because then we're assuming APR assumes how things are calculated, whether they're daily, annual, and all.
Sure. And I think part of the reason that we kind of get uncomfortable when we hear that stuff is it's a lot of marketing fluff. A lot of marketing hype goes into obscuring the numbers and making it seem like it's this huge deal that you should prioritize. And in this case, the difference here is $657 over 5 years.
Yep.
That's
Which
not
is
a whole lot of savings. It's a little bit, but over 5 years, you're talking about saving 100 and not less than 200 a year. And that's not that much, especially when you bring up what you like to talk about, opportunity cost, and where you focus, opportunity cost. In the case of cars, especially, I did a video a long time ago on my channel when I bought a quad, and I analyzed a similar situation. In that case, I could get the bank loan for a little bit lower, so it kind of tips it in its favor. But when you first buy your vehicle, you're never going to get a loan for more than you will get right then because it's going to start to lose value immediately. Right? And you've got to decide, where do you want to store your equity? Do you want to store your equity in the vehicle that's losing value, and if you have to tap into it, who knows what the rate will be at the time you want to tap into it, and who knows how much it'll be? Or do you store your equity in your policy that you know how much is going to be in there and the rate that they're going to loan it to you at?
Right.
There's obviously a ton of value in knowing exactly what it's going to cost you to tap into your equity. Where does it make sense to store it?
Right.
And this is where it comes down to, if you're in the accumulation phase, which probably most people watching this video are, they're going to want to store their equity in their policy to leave room for other opportunities. That if you get we work with a lot of real estate investors. You get a real estate investment opportunity, you could earn 100% on it.
Yeah.
Who cares if you're saving?
Not investment advice, by the way.
Yeah, but well, of course. But there are people that, when they do what they're good at, whether it's investing into your business or you have a specialty that you invest in, you could do way better than the little tiny savings amounts that we're talking here between the different interest rates.
And you, if I remember correctly, you have a background in option trading, and so it's like the one quality trade makes up for a lot of interest from a standpoint.
There's so much risk in that for sure, but essentially with options trading, you can make a 10% return in 5 minutes.
Yeah.
Or you can trade differently and make a 10% return in 6 months or a year. Like there's a massive amount of risk difference between those. But the opportunity is there to do a lot better. And so are you going to focus on that, or are you going to focus on this?
Okay. So now let's talk about the example, the main example that I think created the controversy is the 6% example. And to be honest, I thought Chris was going to say, well, of course. Like you're literally one aspect, you have more money. Like you have more money, and that didn't go that way. And now I want to give him the benefit of the doubt. Maybe he just misunderstood what I was saying. But I would assume let's dive into the if I could pay 4% to a bank and the additional 2% in premiums, how does the math work out there?
That wasn't the one I was going to. Let's do this one first.
Okay, cool.
This was what I analyzed was what you actually talked about in the video, which was when you said if you can get a 4% loan from the life insurance company, and Chris said, well, why would I pay more? Why would I pay more than the 4%? if he's, or no, what was it? A life insurance loan was 6%, but you can get a 4% loan from the bank.
Right.
And Chris
Yep.
said, I would still take the life insurance loan.
Yes.
That was the one that boggled my mind.
Yeah, that's
because,
what I'm saying. That's what I'm saying from a standpoint of this is where I think the real debate is like, why would you take a life insurance loan at 6% when you could get a hypothetical loan at 4% and then take the difference and put it?
Yeah, so what I did was, I mean, just in the loan amount, I didn't even touch the new premium, adding money in as new premium.
Okay.
So here's what it looks like. If you have a 6% loan and the 4% payment is still exactly the same, but you have a 6% loan with the life insurance. Well, what does that do if you're just matching that 4%? Because that's what he said. He said he's matching the 4%, not the 6%. You would say match the 6% and put the extra in as new premium. Whereas Chris said the opposite. Basically, he would pay the 4%. So if he just made that 4% payment, but the loan rate was 6%, then it drags out the payments to age 60.
Yeah, and I actually, James, I actually think, and again, I don't actually think that's what we were talking about. I think we were talking about and I don't know if we have time to dive into the numbers on the fly or if we want to pause, but I actually think the conversation was if the same money, like same cash flow, scenario number one, Chris, I drew it out, Chris pays a 6% loan to his insurance company. Caleb pays a 4%, and the additional 2%, which we came up with just $200, gets paid into the policy. Obviously, Caleb is going to have way more money over time. It's not even we don't even have to do a calculation here because you don't have to calculate it. It's
well, I remember
very black and white.
I remember that part of your video, but that was when I thought he said, why would he do that? He would only make the 4% payment. So that was why I went that was why I went to this. But you're right. And some people in the comments seem to think that was the case as well. With a 6% loan from the bank, the payment would be $19.33. Okay, so I just switched tabs to where I plugged in 6%. Now, in this case, I was just trying to. This wasn't anything I did for a video. I'm doing this for something else, and I also have mortgages here where I'm analyzing the difference. Mm-hmm. But at 6%, the payment's $19.33. So if we go back to this page here, where the life insurance loan was 6%, if you were putting the difference, which is almost $90, right? It's $88.
Yep.
If you were putting $88 in as new premium into the policy, you've got a load fee, whatever that is. Could be 5%, could be 10%. So you're actually adding approximately $80 a month to the balance in your policy, and that's going up. And his balance isn't going up at all in the policy.
Yes.
So if you're paying the same interest and your cash value in your policy is going up, clearly you're going to be ahead. So there's no argument there. In my mind. That is the correct way to do it.
Yeah, no, we're tracking. I think the so far the takeaway is measure everything in APR, and understand when you're taking a policy loan what the actual APR is, and don't let, like, if an insurance company says, "Oh, we're 5%," like it actually might be cheaper, or it could be more depending on how they measure things. So actually understand that. And going forward, I will be more clear with my language. And then the other takeaway is obviously but I just want to click. If you believe that you're actually recapturing interest, you can understand why someone would believe that even at the 6% that you're paying the insurance company, you're going to be ahead because you're recapturing that interest, but that's not accurate. So I think the other takeaway is if you can put more money into your policy and create this, like, you will win over time. And that's even what Nelson said is it's volume versus rate in the shot, the vaccine example. It doesn't matter how fast things enter your body. It's how much liquid enters in your body. And I think that's the thing that I continue to go back to is what position am I able to actually save more? And there is cases if you use your policy loan versus borrowing at a higher interest rate, that's the exact opposite. Is now you're able to save more hypothetically because you're saving money on an interest rate that you're not having to pay the bank. But
Right.
if banks are cheaper, then don't gaslight me by saying you're still going to be better off. You can still say I hate banks. You can still say it goes against my moral code to do business with banks. I totally respect that. But don't say, oh, it's actually better financially. Would you agree with everything I said so far?
Yeah. And let's throw in another little curveball to complicate things.
I love curveballs.
When it comes to the life insurance loans, you have direct recognition and non-direct recognition.
Yes.
So in the case of Penn Mutual, their current dividend rate 6%, loan rate it's like 5.3, but for the first 10 years you're going to get a credit of 0.65 less than that, so like 4.65. You're impacting that dividend. You got to take that into consideration when you're looking at what are you paying for the bank loan.
Right.
Right? So the impact of taking that loan is not just a loan rate of 5.3%, but it's the difference between you would be getting a 6% credit or a 4.65 credit instead of a 6% credit.
You're
not
totally
accounting for expenses in there.
Yeah, and that's
then
where
same thing with Guardian. Yeah.
Yeah, that's where looking at a third party lender could make sense from two reasons. It doesn't affect any of those direct recognition carriers, but then also from a convenience standpoint, what a lot of people don't necessarily want to say in the infinite banking or banking pitch is like, it's not as convenient as sometimes they make it sound. Like, yes, you can call the company, yes, you can fill something out, but these insurance companies don't want to be a bank. They don't want to do a ton of transactions, and it's not. I mean, we've had a few examples where we can get the money fast, and that's like make some special phone calls, but in a lot of cases, you're not getting the money the next day, and so those are just some things to also factor in. Do you ever work with third party lenders for yourself or for your clients?
I do. I have in the past, especially when the rates were lower.
Yeah.
Because I have Guardian. I have a couple of big policies with Guardian, and Guardian, it's a significant impact in relation to the dividend rate if you take a Guardian loan. Not so much that I'm not going to do it because of what I can do with that cash outside of it, but back in 2021, we could get rates at 3% borrowing from an outside lender.
Yeah.
And that doesn't impact my dividend. And when rates went back up, I switched back to Guardian. Now I'm going to be switching again. So I'm actually, at the end of this month, going to be recollateralizing my policy with an outside lender. There's one out there right now that will get us minus 1.25 off of prime, which brings us down to 5.5%. And they have a 1-year intro at 5%.
Yeah, I think I just talked to the owner of that company that you're referencing just yesterday, and so I'm big fans of them, and I definitely think that is something that people should be aware and looking at their options. Let's talk about the last thing on this topic, and then we'll talk about amortized, simple, and compound interest.
Sure.
What a fun conversation that is. So let's talk about the mindset behind like why I would actually take a higher interest rate and keep liquidity in my policy. So just to be really, really clear, if I could borrow at cheaper rates in my insurance policy, why would I still take a higher interest rate loan for something like a car or for a mortgage or even a line of credit on my business? The reason I would do that, not because I'm saying, oh, this is better financially, because mathematically I'm paying more interest, but the difference in interest that I'm paying is something I'm okay with by keeping liquidity, going back to the golden rules. Those who have the gold make the rules. And so, yes, could I pay off my home with my life insurance policy today? Yes, meaning I have more cash value than the balance in my house. Would I ever do that? I would lose so much sleep. I would have so much anxiety if I did that, because it's like, yeah, even if I could save interest, which I wouldn't, even if I could, now I'm taking all the liquidity that's a volatility buffer for my business, an opportunity fund, giving me optionality, and I'm just withdrawing all of that, and now I feel like I'm more at risk than ever. And yes, I don't have to make the payment anymore, but it's like it's not even close in my. And so that's that same logic that goes to, you know, why I probably would never buy a car when companies out there are giving somewhat competitive rates. I'll never pay off my mortgage with my life insurance policy, and I just opened up a line of credit that I don't think I'll ever use in our business, but it's like, why wouldn't I create a line of credit with no fees as just another place that I could tap in? Like, why wouldn't I do that if it's just an option? It doesn't mean I have to do it, but wouldn't it, isn't it better to have the option than no option? And that's kind of how I think about life insurance policy. How would you maybe like push back on that, or how would you explain that? Because I sometimes feel like I say the same thing over and over, and it clearly resonates with some people, but some people it doesn't. How would you talk about what I just mentioned?
We have to recognize it's a personal decision. Some people are very uncomfortable with any type of debt. And so those are the people that argument is probably going to resonate more with, to just not have to worry about it. I know I have one client in particular that was solely focused on paying off their house. That was like the number one thing that they wanted to do. After a lot of discussions, this was like probably a year that I think I met with this person multiple times. And ultimately they were like, I get it. I'm going to actually do this. I'm going to put that on pause and focus on the growth part. But that's not going to be for everybody. So what I like to think about it is, like I said, when we're in the accumulation phase, we're going to be more interested in having those opportunity costs. But when we think about this, and this is where I'll say never, Caleb, because at some point, you're going to have so much money in your life insurance policies, and you're probably getting close to where you're not concerned with that liquidity.
Yeah.
And it's going to boil down to, do you just let the money sit in there, or do you put it to work in a safe way? And this is where you got to put on your other hat that Nelson Nash argues and be your own banker. You're in your business, but you're also in the banking business. So what are you doing with that capital that's sitting idle that you will not touch?
Yeah.
You might find value in loaning it to somebody that you trust, meaning yourself, in order to pay for a car or to pay for your house, because you know you're not going to touch it. Now, I'm not talking you got 100,000 or 200,000 in liquidity. I'm talking you're sitting on millions in liquidity.
Yeah.
Because you're past the accumulation phase, and you always want to have your savings. This is money you're setting aside that you're not going to pull out and risk in your business. Of course, when you have a business and it's a growing business and you have a lot of employees, you value that liquidity way more, because you know it can get sucked up like that. You might need it for anything. So
totally.
At some point in the future, and this could be when we get to generational wealth, that mindset can change. And the ease of borrowing from your policy takes the advantage. Like you're going to shift your priorities, at least on a portion of that money. That's how I view it.
Yeah, I think that's well said. And you might even get to a place where you take a loan, maybe just pay the interest each year, and know that it's like never repay the principal, because you're going to pass away someday, and the death benefit will get passed on. And so there's aspects of that. And are you ready for me to expose myself? I'm going to expose myself. When I drive a Tesla, and we'll leave the details vague for a reason, but I was in one state, bought the Tesla in a different state, got approved for a bank in that state that I was in, but the state that I was picking up the Tesla, it wasn't worth it. And so at the end of the day, I ended up paying cash, and then never refinanced due to just simplicity. Like not to say like, could I have, should I have? Yes, I never did. And is it on an opportunity cost calculator, if I would refinance, put that in the market, I would have had more money. And that's an example of like, I just chose simplicity of paying cash, even though I know over the last 5-6 years, if I would have, taken out a loan and I would have, so I'm just making the point to saying sometimes the math, we don't always like having kids, not necessarily the best decision math wise. Going on vacation, terrible for compound interest. So we make decisions all day long that aren't the best for the compound interest curve. And so I think that factors into that. And obviously the bigger decisions, like I'm exposing myself because really I should have refinanced because of what I know and because of the cost of the car. Like that's a decision I should have done and I didn't. And I'm fine, but like that is an example. Like that decision of not refinancing and investing probably could have cost me hundreds of thousands of dollars over my lifetime just if I invested it in, in the S&P over a long period of time. So I'm just making the point that
I bet 6 years ago, you would have made a different decision probably on that.
Yeah.
And where you're at and the amount of liquidity that you've already created for yourself and your business allowed you to make that more simplistic decision.
Yeah. And so, but just because it's simplistic doesn't mean it's right. I think some people always think that I'm like Mr., crunch the numbers on everything. And I'm actually not. I'm like big picture, but I don't actually, like, if I'm trying to crunch the numbers to figure out should I take a loan for my policy to do X and Y and Z, the answer is no. That's why I make it very simple. For me, this is for me. Yeah. It's got to be a heck yes. Otherwise it's like, all right, if I'm crunching the numbers, factor in risk and the factor in that things usually take longer, that I'm going to get hosed on this thing. So
and time. How much time does it take you to manage optimizing that particular thing?
Exactly. All right, so now let's talk about this idea of amortized, simple, and compound interest. And I've shared this publicly before, but in my book, The And Asset, we actually have a new edition, and we also have an Audible. So if you guys like to listen to The And Asset, it's available on Amazon. And I didn't want to rewrite too much of this because I'm actually going to be working on another book project. And I was just like, if I rewrote this book, I would rewrite every chapter because it's like a little bit cringeworthy as I read through it. I was like, man, like I'm glad, like it's over 25,000 copies sold. It's opened people's eyes. I'm really grateful for it. But there's just so much more that I would say, and I probably would end up overcomplicating the subject, like most veterans do. So I was just like, I'm going to do the bare minimum. So what I did was I added my dedication. I dedicated it to Greg Guilliams, who helped me start BetterWealth, who was my first death claim that I ended up paying out. So I dedicated it to him. I acknowledged many of the people that I wish I would have acknowledged the first go around. And so I've acknowledged those. And then I made really one edit, and the edit was in my housing efficiency example where I talk about amortized interest and like what you would pay versus what you would have earned. And the reason I changed it is the math wasn't wrong, but it was misleading. Because I was essentially alluding to the fact was, well, if you could only pay, I'm just making these numbers up, if you could only pay $15,000 of interest over 5 years, but you could make $35,000 worth of interest, wouldn't you pay 15 to earn 35? Yeah, duh. And yet I'm giving myself the benefit. I didn't do this like nefariously to screw anybody. I just like that's what I was taught at the time. What I didn't factor in was, well, that one's on a compounding. One's literally compounding. The other is paying down principal, like what you just showed, and we're not factoring in what those payments could have been earning if you put them in the same deal. And so I just want to be very clear, if we're dealing with APR at the same interest rate, whether it's 4%, 5%, 6%, 7%, 8%, paying down a loan at an APR of 8 and earning an actual yield of 8 is identical over time if you factor in opportunity cost. Now, in many cases, people don't invest the difference. They're not disciplined. So I think you need to factor in human behavior, but mathematically it's identical. And so that is a pitch that a lot of people use on the insurance side to sell like why you should put money into life insurance. And I was clearly taught that and influenced in that early on. And that's why it showed up in the book. And that's why I changed it in version 2. So I don't know if this is making sense, but this is where I want to like start our conversation when it comes to that, because I see a lot of people talking about it, and I was one of them back in the day, so I can't be too judgy. If you're a high-earning professional, entrepreneur, or someone who wants more control of your money, we offer something called a Clarity Call. It's a one-on-one conversation where we learn more about your situation and walk you through how integrating whole life insurance could help better your financial situation. It's no pressure or fluff, just real clarity on whether this strategy is right for you. Click the link in the description or tag comment below, and we'll walk you through exactly how we can help you.
I'm going to have to take a look at the changes that you made because it did confuse me a little bit, your example there.
Okay.
And in that, there is a difference between compounding growth and paying down a debt. An example that I like to look at is at the beginning of the year, if you have the ability to contribute to a Roth, oftentimes people will look at and say, well, I've got to decide, do I want to fund my life insurance or do I want to fund the Roth?
Mm-hmm.
And most of the time they'll just fund the Roth over the course of a year. So let's say they're putting in $500 a month into the Roth.
Yep.
That gets you $6,000 over the course of the year. Well, if you have $6,000 available in your life insurance policy, and you can borrow at 5% in your life insurance policy, and then you fund the Roth right at the beginning of the year, and then you take those payments that you would have paid to the Roth over the course of the year, and you pay back the loan. You're going to pay back the loan over the course of 1 year. And that 5% loan, you're essentially going to pay 2.5% on it. Right? Because that's the curve. You went from 5% at the beginning. You're still paying 5%, but you essentially paid it on half of the loan balance throughout the course of the year. So you essentially paid 2.5%. So what do you need to earn in the Roth to make that worthwhile? Above 2.5% over the course of the year. So that's your difference. When you add years to that, that's just 1 year, but you do that every year. You do have a compounding effect on getting the money in earlier. That's going to be different than paying that loan down, because every time you pay that loan down, your APR drops. And if you go back to my my example here, let me share my screen again. If we go back to the example here, and we're looking at mortgages, we've got a balance that's going to go down every single time you make a payment. Those are real savings, and the APR goes down each year. So you're not going to pay the same APR every year. But so how are you comparing? When you said if you match the APR and the APY, they're not going to match. Your APY is going to increase over time, while the APR is going to go down. Now, this is just making your traditional 6% monthly payment to a bank, which the APR drops barely. It doesn't drop very quickly.
Yeah.
But when you factor in your compounding, you should be going up faster than this is going down. So the APY and the APR are not going to match. That would be my argument. I think you were more right originally, as opposed to what it sounded like you had switched to.
Well, let me share my screen, and this is just a basic. This is going to just be a basic calculator. Let's walk through this. And so what we're going to do is we're going to break down this idea of compounding versus amortized, and I just want to share kind of where I see things going astray a little bit. We're gonna, just to make things simple, we're going to have we're just going to use annually, just to make it like simple. It should, whether it's calculating annually at 10 periods or calculating monthly, it all makes sense. But I just, from a simplicity standpoint, I'm going to use a 10-year time period, and something compounds over 10 years, and then you're paying something down over 10 years. Are you good with that?
Yep. Just to be clear, when we say compounding, I don't like to say compounding versus amortized, because the compounding is the interest and the principal, and the amortized is just the principal that gets amortized.
It's just we're going to find what we're going to conclude. I hope, unless something crazy happens, is it actually, when you factor in opportunity cost, it's actually a wash if you're talking about a true actual rate of return being equal. Now, I think where we could go down the road is if there's something slightly off on an interest rate, then of course whatever it's slightly off on, it's either going to be in your favor or against you. But we'll see how this works, and I think it will be beneficial for me to talk through this. So you have $100,000. That's the example we're going to use, and let's just say over 10 years at a 5% interest rate, this future value is going to be $162,889.46. So it shows negative, but that's what that would grow to. So you can see that you would have $62,889.46 of interest, and how that would be, really, really beneficial. Now, what would happen if we were to, have a $100,000 loan, and let's say we're paying this thing off. So we want to find out what the payment would be. Well, we're going to go to future value 0. We're going to say we're going to pay this off over 10 years. So these are going to be an annual payment instead of a monthly payment, same interest rate, and we're going to get a payment which should look very familiar based on the math that you ran behind the scenes, $12,950.46. The only difference, James, between when you were running your own is the monthly versus the annual. So we have,
which does make a difference when you're paying it off,
right?
Because that, like we showed earlier, that interest gets sucked out to the bank every month.
Right. So if you have this payment, and this is what people will say, is if you take 12,950.46, I'm just going to do this on my phone just because I want to share like the pitch. 12,950.46 times 10, you get $129,504.60. So the pitch goes very similar to this. If I could pay under $30,000 worth of interest, but I could earn, in a $62,000 worth of interest, wouldn't you rather have an additional $32,000 worth of interest? Like, we would all take that if that was the only thing that was shared to us. Is 62 better than 30? Yes.
Oh yeah,
okay.
But that was the not really apples to apples, because you're starting with 100,000.
Well, but it's
you got to start
with
the
comes
payment.
down to if you have 100,000, whether you want to pay it off or not. We're assuming that you can make the decision, because that is the definition of an apples to apples comparison, is paying cash versus financing. Well, you have to assume if you don't have the cash, well then we're not comparing apples to apples. You just have to factor in, like, it's either buying this thing or not affording it. Does that make sense?
Oh, I see what you're saying. Gotcha.
So I use having the cash is just like the principle is a principle. It's just like whether you have the cash or not. Some people watching this don't have $100,000. It doesn't matter at the end of the day, because we could be talking about $1,000 example or $10,000 example or $1 million example. So here's what I'll say is that what a lot of people in the infinite banking community will talk about is this idea of, there's something really magical about you compounding over time, and then you pay things down, and they'll use things that will pretty much say, like, wouldn't you rather have 60,000 better than 30? And everyone would be like, yes. And this is, again, in my book, I use that example as a way of talking about the difference between, why you want your money compounding. But here's why that is misleading is if, let's say, you paid cash. Let's say because if I just stop there, you'd be like, oh, I'll finance all day long and I'll have $30,000 more. But let's say I paid cash for the $100,000 deal, and now I have the $12,950.46 that can compound. And if it compounds over time, drum roll please, that number should look very, very familiar. It's a 0.03 cents off. and it's identical to what your 100,000 would be if it was compounding at 5% annually. So the point I'm making is I still would choose the financing because I would rather have control over my money. But there's not anything like super magical when interest rates are identical to whether you pay cash and then actually invest the difference, which most people don't, human behavior, or whether you do the exact opposite. But sometimes if you're just looking at the interest that you pay versus the interest that you earn, it's not showing the real picture because you're not factoring in them saving and investing the difference at the rate that you're assuming it can grow.
I think that makes sense. Essentially, if you have the cash, I mean, the value that a lot of them are arguing is that you're actually getting that. Like, certainly if you have a whole life policy, you can pretty much bank on what that return is going to be. Whereas if you would normally just invest that, who knows what you're going to get.
Right.
So there is some consistency there, and it can be good for a lot of people that don't really have, they're not investment savvy.
Right. The point of this whole thing is, it's nothing in real, like, you'll never have a scenario over 30 years that it's identical.
Right.
That's just impossible. So it's not, I don't share this example to say we should do this type of equation every time we're thinking about borrowing, but it just goes to, like, I try to oversimplify things to saying, okay, if my actual APR is, let's say, 5%, the conversation I need to have is, can I earn over time more than 5%? And if the answer is not sure, no, then it's like, okay, then that makes that decision clear. Maybe I shouldn't take any loans because it's an equivalent of me investing in a 5% deal. But if the answer is no, I think over a long period of time, I'm confident that I can earn more than 5% or way more than 5%, then whether it's a life insurance loan or whether it's something else, it's like I would be better off taking a loan from a bank, a car company, my father-in-law, and keeping money to be able to invest. Now, factoring in risk, factoring in what you invest that money, you lose it all. Like there's all those, and that's where you have to factor into the equation. But that's like, for me, the calculation that goes into my head is like, over time, what's the control cost of controlling capital, and what is the opportunity value of having capital? And is it perfect? Could spreadsheets potentially show a 0.1 or 0.03% difference? Yes, but then again, it's like I don't. Then I've already lost if we're using a spreadsheet to figure out that. So that's what we try to teach our clients around, like the control cost versus opportunity, and try to get them to be like, yes, the answer should be yes to take a loan. Make sure that you can or earn at least greater than what the control cost is, but it really, if you factor in losing liquidity, it should be a lot higher if you factor that in.
Yeah. Well, I'll expose myself here too, because we live in the details.
Yes.
But I never do these spreadsheets or anything when I'm going to make a decision either. Because
I love that. I love that
I
you share
value
that.
my
Yeah.
time more. The basic reason that I do this, and the reason I put these things out there, is so that people can see it and understand the concept. It's the concept that's important. It's the movement of money that is what's going to actually save you money. Not that you're going to track every penny and how you move it to optimize it. But if you have the basics down and the concepts, and you can do it efficiently, it becomes second nature to be able to do this stuff. That's what's going to lead to success.
How do you decide when to use your policies and when not to?
Essentially, the way that I look at everything, it starts with my policies. When I own cash value life insurance, I know that the best use of that policy is to max fund it. It's going to be the way I can get the most efficient use of the policy. My IRR is going to be the highest if I'm max funding it, and I'm putting in the most the government will let me. That's the first decision. Like throughout the year, we always max out our policies as we're able to do it. Question number 2, when I have to spend money, where do I go? It's a pretty simple procedure. If I got money in my checking or savings account, we're going there. If I, depending on the expense, if I can use a credit card, I'm going to go to the credit card, knowing that I will pay the credit card off every single month so that we don't pay any interest. So we're using money for free for 30 to 50 days when we do a credit card. Then I go to lines of credit. The lines of credit, you're going to start paying interest the minute you access those. And what I include in lines of credit are home equity lines of credit and my life insurance equity.
I see.
So when I have to go to that line of credit, I have a whole bunch of policies to choose from, and I have a home equity line of credit. So we're going to go to wherever it makes the most sense. And when we get to the life insurance, we've got direct recognition, non-direct recognition, participating index loans, fixed loans when it comes to the IULs. Which one is going to have the least impact on the overall growth? So those are the few steps you go through.
Yeah, it sounds like your framework is, am I going to spend money or not? If the answer is yes, then you go, what's the most efficient way for me to acquire that thing?
Exactly.
And I also want to just point out, you mentioned checking accounts, and some hardcore people will be like, hey, you should be doing, and it's like, no, if you said something very, very important. You're already max funding and overfunding. So
exactly.
Assuming money is in a checking account, it's after you've already made a decision to all the money that you're putting in. And so yeah, if you have $20,000 in a checking account earning 0, obviously it would be better for you to take that. But if you have hundreds of thousands of dollars in a checking account, what that tells you is you might need to be putting that money in a better place, i.e. either life insurance or another vehicle. So I think that's an important distinction. But I appreciate you laying out, and I do almost the exact same thing. Should I buy this thing or should I not? I never look at like payments or something. If I'm going to look at a car, it's like, should I buy this car or not? And then if the answer is yes, then I go back to my personal balance sheet and figure out what's the most efficient source to purchase that. So I very much divorce the buying the thing and how to buy it in one decision. They're two decisions for me, but I do the exact same thing. And it's usually the back of the napkin APR kind of math, not like I just like, how much is this annually going to cost me? And what do I think this decision annually is going to benefit or cost me over time? And is it perfect? No, but it's very simple in my brain. And
yeah, you want to make that decision. You want to make that decision in 10 minutes, not 3 hours, because your time value is worth way more for 3 hours than you're going to save making that decision.
Yeah, exactly. Yeah.
I like to utilize what I call dynamic banking. Other people call it velocity banking. And how much money you actually sit in your checking account is basically going to boil down to what are the unexpected expenses that might pop up that might show up in between when you're checking your balance. And for me, it boiled down to how much does my wife spend without me knowing it? Because when I first got my HELOC and it was tied to my checking account and I was able to just move the money instantly, I would keep the balance at like $100.
Oh my goodness, dude.
But then my wife would go to the grocery store and spend $200, and I would get charged $3 for them to move the money from my HELOC back into my checking account. It wasn't a overdraft fee or anything, right? But it was a movement fee. I'm like, wait a minute, I didn't save that much. So I had to leave a little bit in there. But how much do you have to leave in there? That's how we figure that out. Is what's the unexpected expense? Because the rest of it is going to be a headache if you have to spend too much time thinking about it.
Yeah. We'll have to have you back on to talk about velocity banking, because I think very similar to infinite banking, it can be over pitched, but it can be a very powerful vehicle, especially as an entrepreneur. It's almost the equivalent of a checking account that's earning a lot higher interest. Just one question before we do part 2 on that is, do you ever worry about banks shutting those lines down, like from a risk standpoint? That's that's the one thing that it's hard for me to factor in, because it's one thing to assume that it's going to go on forever. It's another thing to say, like, what happens if a bank exercises their option to close it? Am I left like holding the bag?
That's a relevant question, especially because you just said you just opened a business line of credit. You don't expect to use it, so it's going to be sitting there. But maybe you do end up starting to rely on it, and you use it in order to be more efficient, because for a business owner, if you have a business line of credit, you have so much money that flows through a business account. You could really take advantage of what Velocity Banking has to offer because of what you can offset throughout the month. You do videos with Denzel. I'm sure Denzel would be able to do all the numbers for you and show you how it would work out. It works, but it's something that takes time, and it grows and it compounds, and the benefits of it are going to be massive 10 years down the road if you get started today, whereas the benefits today are going to be smaller. But if you have a large amount of money that you move, the benefits immediately are a lot more apparent. When it comes to utilizing those, though, the thing to be aware of is what's going on in the economy. Let's talk HELOCs, because 2008, banks basically tightened up, and they reduced what was available because real estate prices were coming down. The liquidity that the banks had was getting tight, and so they stopped offering them, and then they also reduced balances, or they said, you can no longer draw on this, you can only pay it down. Most of these things, there's no clause that they can just say, okay, you need to pay this right away. They just cut off your line of credit, and they turn it into a payment that you have to now make, and you can't redraw against the balance. So if you're in a situation where it looks like banks are losing liquidity, this could be, you see run on banks starting to happen, right? So banks are losing liquidity, or real estate values start going down, and you have a HELOC. My recommendation is you just borrow everything out of it that you can. Max it out. Because they may say that you can't draw against it, and maybe you're paying 8 or 9%. I think my rate right now is 8% on my HELOC. That's high. Like, I don't like to pay 8%. But I value the liquidity of that, as opposed to getting stuck with a payment that I have to make, and I can't access the liquidity in there because of how I was using it previously, right? And then you ride that out. And at some point, the liquidity comes back, and then maybe we refinance and we get another HELOC with somebody else, or maybe they open it back up. So you just have to be aware. There is definitely a risk. So it's a good thing to be aware of.
I appreciate how your mind works, because it works similar to how I think, but you just go deeper, which I appreciate. You're like 2.0 of like, I stick at pictures, and then you put calculations to pictures, so which I love. James, thank you. We'll link your channel, and then obviously we'll have your contact info as well. If you want to connect with James, we'll put how you can do that down in the description. James, is there any final thoughts that you have before we land the plane here?
I just appreciate everything you do, and the platform that you provide, and all the education people get. I think it's helpful. I think it helps our industry to show what's possible with this stuff, and we can kind of get away from what inevitably is like probably over 95% of the policies out there that I don't like.
I know.
And I would not recommend people get. The only way we get past that is education.
I agree. So. And the more we grow, which is like, you should be subscribed to our channel, you should be subscribed to James' channel. The more we grow, the more exposure we create, and that's going to be far more valuable than any regulations. Like, if people knew that their clients were going to be able to see videos of ours, that makes them nervous, that tells you everything you need to know. This person will remain nameless, but I met a person recently who he's like, hey, I love your content, but you've causing me some issues, because some of my clients watch your content, they come back, and so he's almost like, I pray that my clients don't watch your content. And we laughed about it, but as I went back, I was like, that is really interesting. If that's already happening today, give us 10 years. Who knows? Maybe I'm super optimistic about this, but hopefully we can create exposure where you almost feel like you'll get exposed if you at least don't disclose things, or show people. And so I actually think we're making a difference. I hear people all the time genuinely reaching out and saying, hey, I have not gotten any training. Can you guys show us or help us figure out how to do X, Y, and Z? So I do believe a lot of things are not just a money grab. There's an incentive around training that's not, you're not sharing this stuff. And so that's why you should be subscribed to James' channel. And if you're not already, to ours, make sure to do that. That's the free way to say we appreciate you. And so, we'll have to have you back on to do a masterclass on velocity banking.
I'll add one thing here, because I have a similar story that happened recently. Sometimes we do response videos, right? And the goal is to educate. We want to make sure that people out there get the correct information. That's my only goal. And so if I see something that's not accurate, I want to correct the record. So I put out a video. I said, this isn't right, this isn't right, this isn't right, this is what it actually is. And then a week or so later, the agent that put out the video emailed me and said, you need to take this down. You've ruined my business. For the first time, I don't have any appointments scheduled. And I was like, that's crazy. Like, that's not my intention. I just want accurate information to be out there. So if you just fix it, I'll take the video down. And they basically threatened me with lawsuits. And I said, look, if your business relies on you putting out the misinformation, you might want to reassess that, because I didn't do anything wrong here. And ultimately they corrected it and I pulled the video down. But yeah, that was an interesting conversation. And it is not my intention to ruin anybody's business. No. So
no, I'm
just trying to help.
I will say this is I can tell you this from experience. Bait them into sending you a letter and then make a video about that. And if their business, if they think your original video hurt them, I don't think the market loves people hiding behind legal letters. And so I've totally, like, when Curtis Ray sent me the lovely gram through his attorneys, at first I got like oh crap, like this is like freaky. And then I've thought, oh my goodness, he gave me such a gift. Like, I cannot believe he gave me such a gift. And so now that was one thing. And then Fisher Investments attorneys sent me an email, and I was like, you know what? I'm not going to fight this because they got a ton of money, and I actually there's no name behind it, so it doesn't work across the board. But I've just found that, like, when I put out the video just saying like this is what happened, I got so much love and support, and then it even forced Curtis to like reach out and say, hey, can we like set the record straight? I think there was a misunderstanding. And I realize again how powerful a platform is. And we're very small platforms relative to the world, but in this space we're big enough to make a difference, and we're only growing. And so it just has changed my perspective. I'm not saying I'll never send a letter out, but I'm very, like, going through what I experienced, I would much rather make a response video, bring someone on, talk it out in the marketplace than spend a ton of money and many years trying to like hash it out through the court system. And so, yeah, that's I appreciate you sharing that. And we're only going to have more stories like this.
Yeah. Well, just keep doing the right thing. And, when you're doing the right thing, you can stand behind it. So,
yeah, cool. James, thank you.
Thank you.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.